Yeah, good day to you out there, my fellow traders. We are here once again, and I welcome you to the class. My name is Olufemi Adeyemo. So, last time we talked about a trading system, the structure, how to structure our trading system in order to make it work for us, so that we will not just be losing our money, unnecessarily. So today we are proceeding by taking on trade management. Now, we have so many ways to manage our trades, because when you look at it, if forex trading is your business and trading India is the core of your business, so every time you open a trade, you are transacting your business. So if you don't manage your trading, it means you are not managing your business. So today we are going to talk about how to manage our trades. There are so many ways that actually will have saved us of losing our hard-earned money to the markets. But today we are going to sort it all out, and I pray that the good Lord will help us. Now, there are so many ways to manage our trades. The first one is risk control. The second one is risk minimization. The third one is risk removal. Then the fourth one is profits security. Then the next one is profit maximization. The next one is trades stacking. Then the last one is cautious risk trades. Now we are going to go through it one by one, and I believe that the time will permit us to cover it all. But at the same time, I don't want this video to be too long. Now let's go. Risk control. Anytime you open a trade, you are actually taking a risk. So whatever you cannot afford to lose, please don't place it online as your risk, because whatever the distance of your stop loss to your entry point to the total amount is what you are placing online as your risk. So now, if you know that certain amounts will not be too comfortable for you to risk, in case you lose it, please don't place it online. So which goes to say, whatever you cannot afford to lose, don't place it at risk. Then in other words, it also means that whatever you are going to risk is what you should consider, that if peradventure you lost this trade, it will not affect your account balance. I hope you are getting me. So that even if you lose like 2 times, 3 times in a row, yet you can still come back to the market and place a trade. So that one may actually help you to recover your losses. But if you are risking what is too much for you to bear, you may lose just 1 or 2 times and the whole account balance is over. That means if by trading, losing a trade or 2 and the whole account balance is wiped out, it means that is a bad risk management. So you need to control your risk. How do you control your risk? You control risk whenever you place a trade. Immediately you place a trade without stop loss, without TP, that means the whole of your account balance is what you placed online to risk. So anything can happen to the whole of your account balance. But to control your risk, define the level at which you don't want to lose, you just have to apply your stop loss. So stop loss means if you place a trade and the market happens to go another way around against you, for you not to lose the whole of your account balance, you have to place a stop loss at an area where if the market actually hits it, whatever you are going to lose at that point will not affect your account balance so much that you won't be able to trade afterwards. So that means risk control. So you have to control your risk, because every time you trade, you take a risk. Now to control that risk, you have to apply your stop loss. So don't ever at any point in time think that you are wiser than the market, or you are wiser than those people that actually defies this means of controlling our risk, which is stop loss. It means to stop your loss from swallowing your account balance. Then number 2, that's risk minimization. So that is stop loss reduction. I used to do this. The reason why, I will tell you now. Number 1, I want you to know that when you place a trade and find you had already determined in your heart that this is amount I want to lose. If the market goes against me and I don't want to lose more than that, fine. But by the time you see that the market actually moved in your favor, and at the end of the day it comes back, pass through your entry points, and then at the end of the day went on to hit your stop loss. That time that the price actually moved in your favor, if you had reduced your stop loss, it means you won't lose more than take for instance, as I used to do. Whenever the price moved into positive for me to a particular point, I will reduce my stop loss. The reason why I do that is that, number 2, a trade that will be a losing trade will always be a losing trade. There is nothing you can do about it. No matter how accurate your trade signal is, your setup, your confirmation, your entry, whatever, no matter how carefully you observe that trade before you take it, a trade that will be a losing trade will always be. So that is why stop loss reduction is very, very good. So if a market should move into positive for you, if you reduce your stop loss, it still doesn't mean that you are the one who caused losses when the losses come at the end of the day. In fact, you'll be happy that, like me now, I used to reduce my stop loss to 50% of what I had before. So if I have 100 pips as my stop loss, I will reduce it to 50 pips. So because I know to lose, a trade that will be a losing trade will always be. So I use that one to also reduce, to minimize my risk, because you need to make sure that at any point in time you reduce your risk. You reduce your risk. So now the third one is risk remover, which is a breaking even. So you should have, at every point in time, have it at the back of your mind, part of your trading plan, that this, when the price move into positive to a particular level, for me, I will break even. That is moving your stop loss above your entry point. Just like, take for instance, this is, you are buying, and then this is your entry point. So this is your stop loss. So by the time the market moves up to like this, let's assume you are going for 100 pips as your TP. So by the time the market moves like 40 to 50 pips, and then you can move your Like that time, I will have had my stop loss around this place, 50%. 50%. That is my own. No, I'm not saying this is what you should do, but do whatever works for you. So now I will move my stop loss up to this level, like 5 to 10 pips. Depends on the market structure at that time, at that point in time, and then it also depends on the spread. So always have this at the back of your mind whenever you are taking the trade. Do you know that because of the large spread, you may not have to take that trade, even if it is so accurate, so sure, you have seen the setup in place, you have confirmed it, and you want to enter, and you now discover that the spread is too much. You have to stay away from it, because all of these things, large spreads, may put you into trouble. By the time the market moves back a little, if you are trading a currency pair that has like 10 pips as spread, that is too much. That is way too much. Your spread should not be more than 2 or 3 pips. So if you want to take a trade and you see that the spread is more than 2 or 3 pips, please forget about it. At most, if you know and you are sure that this market is moving, even moving beyond your TP, that you perceive that it's going to move even beyond where you put your TP, then you can say, okay, I will manage 5 pips. But even that pips is way too much for me, because the way I trade, sometimes I may look at the market and I see that this market will not move so much to do my multiple other trades, so that with a small movement I will capture all of my 100 pips without stress. So something like that, I don't need big spread, it will spoil my show. So it is better I look at the spread within the means of 2 to 3 pips, 3 pips at most. So that's breaking even when you move your stop loss to above your entry points. So the next one is profit security. When you have broken even, you have moved your stop loss to a break even point that is above your entry point. If you are buying, if you are selling below your entry point, so that means you are securing that profit, even if it's just 10 pips or 5 pips that you are moving above your that is between your stop loss that you moved to break even and your entry point. Even that 10 pips can go a long way in being something for you, because that trade has become risk-free trade. There is no more risk on that trade. So all you need to do is you have secured your profit, and what you are waiting for now is to make sure that you maximize your profit, which goes take us to number 5, profit maximization. That is that profit maximization is equal to trailing stop. This trailing stop we are talking about, hey, you do know that I don't always advise the newbie. I'm not saying professional, so the newbies, I don't always advise them to do these things, because it will somehow cut you out of the market, and then the price will continue in its previous direction. Why? Because some of us, we don't know how to do the trailing stop. And even if you are a professional, you have to do it wisely, do it intelligently. Otherwise you will lose that big move that is about to occur, because sometimes the market may move and move and move and move. By the time you could just hear pam, it will just begin to move as if something was chasing it, and you at that time, how will it be with you, or how painful will it be if you get to the market and discover that the market had retraced, cut you off, and then move back up to the previous direction, and it has now moved like 200 pips. When you came back, you feel very, very bad. It has happened to me before, so I always want people to be very, very careful. Sometimes when I look at the market structure, I look at it. If I stay at my break even, I know that I am 80% sure that the price may not retrace back to that point before it now blow up like that. So if it happens like that, all the same, my profit is growing. So but if you know that you can do it, there are so many ways to do trailing stop. There are so many ways. One of the ways is, let's see, the market moves like this. So let's assume that we are buying. So this is your entry point. So if you have down, fine, we are break even here, and then the market is moving. So anytime the market comes into retracements and then reverse back when the retracement was over, and then moves back up, then you are free to move your stop loss to this point, at least a few pips below the point at which the retracement recovered. So you move your stop loss here. So when it continues to move outwardly, naturally the price will always retrace, move upward, retrace, move upward. If it is a sell trade also, it will move downward, create a lower low, higher high, low, something like that. So now if you move and it comes back to retracement, so anytime the market enters into retracement, it's an opportunity for two things. If you are trailing your trade, you are trailing the price, it is an opportunity for you to move your stop loss up or down a little bit concerning it depends on what the trade you have. Maybe it is you are in buy trade or sell trade. So it's an opportunity for you to move up your, like now this one now. So by the time this retracement recovers back upward, then I will move my stop loss from this place up to this place and stay here and wait for the market to move up and do its own thing again, because it's a natural thing. Market will always enter into retracement. For how long it will go, nobody knows, but when you are very, very careful about it, you may not get caught up. So by that time, what you are doing is you are maximizing your profits. So the more you move your stop loss, the more, let's assume that this is 10 pips for your break even, then here now we have like 40 pips. So plus this one now you have 50 pips, which is very, very secure. Nothing can, if the market comes back from at that point, hit your stop loss here, you have 50 pips secured. Nothing. So now, so that said, I told you that retracement recovery give you two opportunities. Either this one I'm talking about, that is your trailing stop, or you want to enter afresh, or during the trade stacking we get there. So if you want to enter, immediately the price move back up, recover from the retracements, then you enter here and you buy. So that's an opportunity for entry, accurate entry, an entry that is, that will give you a minimal risk, because once the price take off here, it is not likely that it will come back here. So your stop loss may be around this place and your entry point will be around this place. And then, so those are the two things that a retracement recovery does, and it is very, very good. So now that's for that. If I try to dwell more, there are so many other systems for trailing stop. So if I'm interested in that trailing stop, one day we might want to use learn it as a particular topic on this channel. But then if it will happen so, fine. If it is not going to happen so, if you're interested in trailing stop, you can do research on how to do more of trailing stop. so that you will not always miss a big move in the market. Then the next one is trade stacking. I told you trade stacking is very easy if you know how to do it very well and you are very careful. You are very careful. You do it intelligently. So how do we do it? It is more like when you are doing trailing stop. So trade stacking. Trade stacking in the first place, it means when you have opened one trade on the same currency pair, on one currency pair. So by the time it is moving on and on, you want to place more trade because you foresee that the market will continue to move. I told you that funny as forex market is, it also affects all other assets also. It may move in a particular direction for 2, 3 months, 4 months, 5 months, 6 months. So if you are able to catch this type of move, oh my god, in fact you can do a lot of stacking by placing more trades as the price is moving up and on, and you are placing more trades in order to if there is any word like that, bigamize your profits. So how do you do it? Now let's see. So if you are stacking your trade, this is the first trade 1. So by the time the market moves and enters into retracement here, and then the recovers and move back upwards. So here now you place your trade 2. So you wait, and then the price move also enter into another retracement and then move recovers. By the time it recovers, trade 3. But then you do it on and on like that. But then there is something I want to discuss with us about the stop loss. Now this question may come like, okay, what if I'm stacking my trade like that? Fine, everything is going on fine, that market is moving as expected. How do I put my stop loss so that I will say that if you want to truly maximize your profit, you can do it one of these 2 ways. Everything we do, it has advantage and disadvantage, but you look at the advantage. If it is more than disadvantage, then you pick it. Now if this one now, you have already moved stop loss here, right? So if you open this one now, if you like, you can move your stop loss this place to this place, and then use this trade 2 is so stop loss, let it be here also. You want to have 2 stop loss for trade 1 and trade 2 here, so that if the market comes back and hits this place, whatever you lose here will be deducted here, and the rest will be your profit. So you will not lose after all. So when the price, let's assume the price did not come back and you have 2 stop loss here. So if the market continue to move like that, then you also move this one stop loss to this place to be a break even, and you move this another stop loss down here too also. It should not be 2 BE or stop loss points. So then you continue to move like that, move it like that, move it like that. That is one area. So then the second one is when this one had already broken even, this one has become, so this one also that become risk free. So this one also, by the time you enter and the market continue to move, you move your stop loss above this one for a break even also. So this one will remain where the break even will remain what it is. This one also, the break even will remain what it is. Then this one also, by the time this is your stop loss, this is your entry. So by the time the market has moved, then you move it to BE. You leave it here. So you have one BE here, BE here, BE here. So, and as you are moving along, you are doing that way, so that everything is just piling up and piling up. But the advantage here for this one is that if it's moving back and they cut this one off at the break even, or even at worst at stop loss, it may not get to the other thing before it now moves back from this place. No, don't forget this is the stop loss. It has cut this one off and then you now depart back from this place. But if you move all of your stop loss, you are moving it after, and it comes to cut something like this, all of those trades will be off. So you won't have any trades left in the market. So it is better to remain always at break even for each of the trades, so that if you cut one off, you still have the others left behind. As long as it is not that the price has entered into total reversal. I hope you understand me that way. So then the 7th one, which is the last one for today, is cautious risk trade. Cautious risk trade means that you had already, the first trades you place. I told you sometimes you don't have to place so many trades before you can make money and good profit from it. So always do this thing. Place one trade at a time. At most 2, depends on your account balance, but make sure that you calculate the risk of both. If both, you will assume that if both stop loss were hit, they will still not affect your account balance. You can go ahead and do it, but it is better to enter into one trade at first. So when that one trade enters to break even, then you know that you have risk-free trade on ground. Then you cannot look for another trade to trade, especially on different currency pair. That's where we have cautious risk trade. That is, that one, the first one has entered into risk-free trades. So now if you are opening another one now, it will look as if you are just entering into the market without risk. So all the risk you have to go through is the risk of the new that fresh trade. So when you enter like that, then you set your this thing. So immediately the thing move in your favor and you enter into breakthrough or break even. Also, you have 2 trades that are risk free. Then you can open another one if only there is good and accurate trade signal. You don't just because you have risk free trade on ground and then you are hoping for the best that this one will continue to give you profit and maximize your profit. You not because of that begin to open useless trades. It will cancel out and wipe out of all those opportunities you have had. You just waste that opportunity. You will waste that move because it doesn't happen always. But if it happens that way and you maximize it and you take advantage of this, I'm telling you, it will be you'll be very happy. So now where we are now, this is the end of the lesson for today. Maybe sell trade or buy trade, but then whatever you have secured at that point in time is that profit that you have secured, and that profit, I tell you, it can grow more than what you had already secured. So that takes us to number 5, that is profit maximization. So then the market begin to move all around and on, or you can do your trailing stop or leave it at break even and let the price continue to move for as long as you want to move. Then the third one is trade stacking. Trade stacking meaning that you are doing that on same currency pair. So whenever there is an opportunity for you to move your stop loss, opportunity when there is a retracement. When there is retracement, then it's an opportunity for you to stack your trade. As long as you are sure that this price will move on and on for a long time, then you can always use that area. So whenever the price recovers from the retracement and move back upward, then immediately you enter another trade. That way you are stacking your trades. Then the final one is cautious trade, the way I just explained now. Cautious risk trade, that is, you do that on different currency pair. So when your trade, the previous trade that you had enters into break even, you had already turned that one to risk free, and then you are free to trade more, just to increase your profit. But don't enter into too much trades. Over trading kills accounts, because over trading is not even good. If you enter like 2, 3 or 4 trades, do you know that 2 or 1 may enter profit, give you good profits, but the other one will erode that profits, because when they begin to go into negative against you, this one is going to positive against you, and at the end of the day, do you know that you have to use the profits you have made to pay for losses of the other ones, if you are lucky enough. But if you are not lucky enough, even all those negative losses will actually erode your profits and even hit more into your account balance. So be careful when you are trading. Don't be too greedy, and don't dull yourself. Whenever the market presents you an opportunity to maximize your profits, all of these things I've discussed today, try to apply it. So you can do that. You can start by practicing it on your demo account. So by the time you are good about it, good at doing it, then apply it to your real account when you are trading. I believe that you have learned 1 or 2 things today. So if you have not subscribed to this channel, try as much as possible do so that whenever we post another new video, you will be the first, or among the first, to be notified. Like it, share it with other people, so that the YouTube may recommend to other traders like you. You cannot exhaust the market. If every trader are taking $1 million out of the market, still the market will not still be exhausted. So you don't say because you need market money in the market, you don't want to introduce other trader to it. We can all be millionaire in this game if we have the same mind, the same way of doing things. But unfortunately, some will lose because of the psychological effects that the market is having over every one of us. We have our own level of experiences, we have our own level of IQ, and so many other factors that come together to make us who we are as traders. But I believe that when you are highly disciplined and you actually determined to succeed in this market, the rest is easy. I pray that as you strive in your career, in my career as forex trader, we will excel and we will succeed. We shall not put to shame. So next time, I still remain your mentor, your teacher. So whichever you see me as, no problem. So let's just do this and continue to excel and continue to improve our incomes as forex traders, so that we can have 1 or 2 things to point out that this is what I used forex trading to achieve in my life. I pray that our career will not be a failed one. So let's continue, and we will better this ahead. As I used to say, don't give up. If you give up, you are the most loser. If you give up now, everything the market has swallowed from you has gone. But if you don't give up, there is hope for you to recover all your losses in the market by the time you got there. So don't say because today you are losing your money. In fact, the way the forex trading is being structured, nobody should lose money before he knows what he's doing in the market. There are demo accounts for you to do, but because you are just in order to make money, you begin to use money to do testing, which is not a good thing to do for a right thinking man. I'm sorry if I sound so rude or sound as if this is the raw truth, but we have to embrace it in order to get better. Please don't do testing with your real account. Demo trading is there. Do your demo account for testing to test everything, your trading system, your tricks, and all of these trade management tricks and all that. Use your demo accounts to practice them until you are very good at doing it, at implementing it, so that by the time you go to your real account, it will look as if this is what you have been doing. It is not new, and you will do it successfully, and you will see that your profits will begin to skyrocket, and then you begin to make more money. You improve your incomes in the market, and the more you are doing, you are growing, the more you feel comfortable in the market as a trader, the more your confidence begin to rise, and you know that yes, now you are good to go. So I used to tell people, I say, look, when they are asking me for how long will it take them to begin to make money in the market, or some even want to start trading by borrowing money, maybe from cooperative, maybe from friends and family, I said, don't borrow money to trade forex. It will put you under pressure and you will lose everything, I'm telling you. So you don't need money for now. What you need is to know your system, use your demo trading to do everything, to practice and practice and practice until it becomes part of you. So I used to tell, I said, look, when it is time for you to trade on real accounts, nobody will tell you. You will know by yourself. So that time you will have had some money kept aside for this purpose. Then you go down and take it. I say nothing is too small to start with trading forex, and nothing that your small fund cannot, it can grow up to anything if you apply patience and discipline to your trading, and then along with your experience and your ability to be sensitive to the markets. So now we meet next time. So I say for now, bye bye, see you later.